Well, cooler than expected core CPI out of the States spurred some dovish bets on the Fed outlook last week, allowing the S&P 500 to post its best week since November as treasuries rallied across the curve, causing the dollar to snap a 6-week winning run against a basket of peers. This week, all eyes remain on the United States, specifically Washington, D.C., as Donald Trump returns to the presidency, with markets squarely focused on Trump's tariff and tax policies. But it's a busy week besides that as well, with earnings season rolling on, a packed data docket lying ahead, and the Bank of Japan set to decide policy too. Plenty for us to discuss in this, the first trade-off of 2025. So without further ado, let's crack on with the show. Well, it's all set to be another intriguing few days ahead for financial markets. Joining me to try and make sense of it all is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. And Ryan, I know we're well into January and well into the trading year now, but this is the first episode that we've done. So very happy new year to you. And how are you seeing the first few weeks of 2025 and the developments that we've had pan out so far?
Yes, happy new year to you and all our viewers as well. This is it. This is the start of it. You'll have to excuse me if I start going cross-eyed during the show, because I've got about 3 eyes on different screens at the moment, because we're already trading Trump mayhem, and this is how it's going to be for the next 4 years.
Well, yes, indeed. We were just discussing before the show how, we spent years headline watching when the US-China trade deal was supposedly 90% done. And as you rightly say, we're filming this about 3 hours before Trump takes the oath of office. And it looks like we're back to those good old days again.
Yeah, absolutely. Euro dollars just trading 104, up from 102.60s or something this morning. So we're we're in the thick of it already.
Indeed, and ye of little faith out there when I said we wouldn't get down to parity last year, but never mind. Let's see what happens with that one as the next few months progress. In the meantime, let's get our teeth into topical thunder. So while, of course, there is plenty going on in the United States this week, I actually want to start with a look at the United Kingdom, because it has been, well, I guess you could say, an interesting couple of weeks here in the United Kingdom to kick off 2025. The week before last, we saw gilts throw what can only be described as a tantrum, to be completely honest with you, a brutal sell-off across the curve, taking the 10-year yield to its highest level since 2008 and the 30-year yield to its highest level since 1998. Good year, that, by the way. And then last week, we saw both fall about 20 basis points as markets got all gloomy once again over the level of activity here in the UK and actually the incredibly anemic growth prospects of the UK economy. To run through some of the catalysts that we had last week, we did on, well, I guess what is the only positive we had out of last week was the December inflation numbers, which saw CPI rise by 2.5% on an annual basis, down from the 2.6% that we saw in November. Clearly still above the BOE's target, and there are a few statistical quirks that cause that number to come in a little bit below expectations relating to airfares primarily. But nonetheless, it has pretty much nailed on the chances of the BOE delivering a 25 basis point cut at their first meeting of the year on the 6th of February. That is pretty much where the good news ends, to be completely honest with you. When you look at the GDP data, the economy grew by just 0.1% on the month in November, which is hardly cause for celebration. And if you think that's bad, the December retail sales figures were just downright ugly. Sales fell by 0.3% on the month. When you take fuel out of the retail sales metric, they fell by a whopping 0.6% on the month. And of course, remember, December should be a good month for consumer spending. Everyone's going out and buying their Christmas presents and spending in pubs and restaurants and hospitality, etc., etc. Well, not here in the UK. It looks like everyone got a lump of coal in their stocking and maybe an orange if they were lucky. Nevertheless, All of this data does nothing to really change the situation here in the UK. We're still dealing with an economy that has next to no economic growth. We're still dealing with pretty sticky inflation. Let's call a spade a spade. It is stagflation. And as a result of that, we still have next to no fiscal headroom. And I think the markets, despite that retracement that we've seen in gilts, are really still looking for a strong commitment from the government as to how they are going to balance this situation and what spending cuts or even further tax hikes they are going to deliver as a result. Now, I know you want to talk about euro sterling in a second, Ryan, but firstly, cable, we're trading, well, when I wrote this, we were trading below 122 at almost 2-year lows. Of course, the news that we've had on tariffs has seen the market retrace course a little bit, but I still think further downside is on the cards, perhaps a test of the 120 handle. And in the gilt space, I don't think the worst is behind us. But of course, the FTSE ended last week at a new record, which is a great chance for me to use one of my favourite market sayings, which is that the stock market is not the economy.
Yeah, very much so, because we've spent pretty much all year watching it go sideways. Somebody wants to have a little bit of a break. Yeah, where do we start with this one? Through a lot of last year, we were talking about pound exceptionalism, the data holding up. It wasn't the greatest, but it was holding a bit better than we're seeing in some of the European countries. And now it's like a light switch has gone, and we're now looking very, very negative. Investors aren't liking what they're seeing. They're pushing yields up, demanding a premium to lend to the UK. That's knocked out, as you say, the fiscal space that the Chancellor managed to build for herself. So now she's got to do more of the same to get that back, and another rally in yields just knocks that out again. So that's pretty pointless. Pretty much the government's got itself in a bit of a pickle where, yes, it wanted to come on strong on maintaining the finances, making sure that we can cross the I's, dot the T's, and make sure all the pennies count. But it's come at the cost of growth, and everyone's going, well, where's the growth that's going to pay for it all, for any additional borrowing and everything you're trying to do? And it's not there, and that's what the market's seeing at the moment. And it's taken a very, very dour view of it. And I think it's potentially only going to get worse. You mentioned the CPI data. Yeah, we had that funny quirk where apparently they decided to take the price of airfares on was it Christmas Eve or New Year's Eve? The two lowest days where
it was a weird one. It was I think they took the outbound flight prices on, I think it was the 9th or the 10th of December, so before the school holidays when prices go up. And then, as you rightly say, they took the figures for returning flights coming back to the UK on Christmas Eve and on New Year's Eve, when basically no one is travelling anyway. So as you say, prices are naturally a bit lower.
Yeah, exactly. But I think we're going to be, just on the economy, we were talking coming into this year that it's going to be a rock and a hard place for the Bank of England. Do they move on inflation? Do they move on the growth worries? And I think now they're going to be pushed into moving on the growth worries. The pound, cable's been clobbered, but it was being clobbered all the way from 134. That's mainly on the dollar side. That's really why I wanted to look at euro sterling for what's going on in the UK, because it is a bit more reliant on what's happening in the pound. Takes the dollar out of the equation, and you can see a bit more whether the market's getting reflected, because as we're seeing right now, we traded down to 121 in cable. Bit of Trump headlines, we're up through 123. Meanwhile, euro sterling is just still remaining quite well bid. We had that big move down to the 82, near the 82 level. Very, very big level that I was talking about for quite some time. We held that. Now we're moving back up towards or through the 84 level and heading perhaps towards the 85 level, which again is another very, very big level. It was on the way down when I traded quite often, trading bounces off of that one, and we're getting up to that point again. So from the technicals, if there is further bad news from the UK, then potentially we're going to break this level 85s, or perhaps if the market thinks enough's enough, we're done with that for the moment, or the Chancellor and the government comes out with some more market appeasing measures, then we could see a bit of a top going in there. But I think that this pair is a bit more reflective of what's going on in the UK rather than cable at the moment.
Yeah, I would agree with that. Just take some of the distortions out. And if the government come with market appeasing measures, we might see pigs start flying as well. I mean, I'm certainly not holding my breath for that one. But one thing that certainly is still on everyone's minds here in the UK and actually across the globe is the situation with inflation, because although things are getting back towards 2%. I think inflation is still going to be one of, if not the big driving force behind the monetary policy side of things this year, as we continue to move back towards those neutral rates.
Yeah, absolutely. And my long-held view on the relationship between central banks and inflation is that they have as much influence over that as they do the tides in the sea. It seems, once again, we're seeing inflation doing the exact opposite of what they want it to do. Over in Europe, we've had yet another round of higher inflation numbers last week and the week before. The PMIs have mostly pointed to increased price pressures too, as have inflation expectations in both the ECB's own survey and the Business Confidence Survey. Over in the US, we saw the NFP data. Wages, they came off a pip on the yearly number, but still remain strong around that 4% annual number. The ISM services report saw a big jump in the prices paid index. We also had a big jump again in inflation expectations from the Michigan survey. And that's all the while, CPI in the US is remaining very stubborn. It refuses to go to 2% in a hurry. And the core has now been above 3% for nearly 4 years. And that's despite a 1 pip drop in the report last week. So while the Fed are at least acknowledging this bout of inflation and they're acting by likely going on pause with rates, the ECB are still holding out a lot of confidence that it's just a blip. Even several members are still doing victory laps over it coming down. And so I think this first quarter is going to be very important and a huge decider for what path central banks are going to be forced down for the rest of the year. I'm going to ask you the question, our old mate Dickie Matthews, is he finally going to get more rate hikes for the Fed, or is perhaps ECB heading to trouble by ignoring those risks of an inflation bounce?
Well, it's certainly an interesting one. Actually, funny you mentioned Mr. Matthews. I'm seeing him in about an hour's time. So I will let you know what his views are on the policy outlook. I'm sure he's still betting on that elusive rate hike. I think the situation is actually different on either side of the Atlantic because of what is happening in terms of economic growth. Here in the UK and also in Europe, and certainly more so in the Eurozone, there is the potential actually for the disinflationary process to quicken quite considerably if the demand side of the economy really falls off a cliff, as you are already starting to see happen in the Eurozone. The manufacturing sector has been contracting for God knows how many months in a row now, and the services sector is following quite rapidly behind that. I think also from the ECB's point of view, they yet again in early 2025 find themselves as the only thing holding the Eurozone together. You look at the largest economy, Germany, has no effective political leadership and probably won't for the entirety of the first quarter. You look at the second largest economy, France, they have no effective political leadership and likely won't until the summer, when you'd expect they're going to have to hold more or another round of assembly elections in France. So the ECB are almost sat there in what is actually, to be honest, a very unenviable position, as they need to deliver rate cuts in order to provide some greater stability to the Eurozone economy. They don't really need to worry about upside inflation risks. And they've also, of course, got the spectre of a potential trade war with the United States, against which they want to try and insulate the economy. So I think the ECB are going to cut quite quickly and quite deeply in the early part of this year. I think in the United States, the situation is a completely different one. As you said, inflation, CPI at least, it seems that 2% is now a floor as opposed to a ceiling. So that is keeping the Fed, well, they're certainly going to skip January. Whether that becomes a prolonged pause or not, I think is now the question. But when you get data like we're getting at the moment, which I'm going to get onto in just one moment, it really isn't an economy that is screaming out for rate cuts. So on a pure policy divergence play, you'd really want to just park yourself in the dollar and wait, I think.
Yeah, I think very much so. And you're absolutely right. I mean, could they get caught out by inflation in the Eurozone? Maybe, maybe not. I agree with you 100%. If the demand side falls off, then you're going to get disinflation coming through naturally. I also think, and that's my big play for the early part of this year, that I still think the ECB are going to have to take rates lower than what they expect and what they want to try and then stimulate the economy. But you've got to remember, because it's a block and there's different countries, you've still got countries like Spain who are outperforming and still doing quite well compared to others. Whether they catch the same cold or not, it remains to be seen. But it's not every country, all going in the same direction. There's a north-south divide, if you like, and this time it favours the south over the north. So we might find that we get the southern states having to bail out the northern states for once.
Well, do you know what? I'm very glad you said that, because it is an incredibly rare situation. I think it's probably the first time in the 25-year history of the Eurozone that the south is actually outperforming the north. How long that can continue for is obviously anyone's guess, but it certainly seems like that could persist for some time to come. Anyway, we could talk about the merits of having one monetary policy for 27 different states, is it? Something like that, until the cows come home. But we best not, because we've got other more important matters to discuss. And I touched on the US data that we've been seeing a moment ago. And I mean, it's been an incredibly strong start to the year from an economic data perspective in the United States. We had that blowout December labour market report towards the start of the month. Payrolls rising 256,000 as the 2024 drew to a close. Unemployment coming down to 4.1% and earnings growth cooling to 3.9% on an annual basis. We obviously had that slightly cooler than expected core CPI print last week, which sort of set the doves running in terms of Fed policy. Core CPI at 3.2 from a prior 3.3. That's the slowest annual rate since August. And also, if you look at the retail sales print, consumer spending remains relatively solid. I know we had that miss at a headline level, but the important metric, as always with retail sales, is the control group metric, because that is the basket of goods that feeds into the GDP release. Control group sales were up by 0.7% on the month in December, almost double what consensus had estimated. And we also saw an upward revision to the November data as well. So when you look at all of that, I mean, that is one hell of an inheritance for President-elect Trump to be receiving from his predecessor, Joe Biden. I think it's undeniable, really, that the theme of US exceptionalism and US economic outperformance that has dominated markets certainly last year and even for most of the year before is continuing. And as we were just discussing, Ryan, I think it's clear that the Fed are on track to skip the January meeting. I think the question for me is, does that skip become a pause? Do we see them do nothing in March, perhaps do nothing at the May meeting as well? Now, we heard from Chris Waller last week, who is one of, if not the most influential members of the FOMC outside of Chair Powell, and he left the idea of cuts in the first half of the year on the table last week. But naturally, policymakers are still very much data dependent. And actually, when you look at the data, as we just said, this is not an economy that really looks and go, you look at it and go, we've had 100 basis points of rate cuts. Let's do 100 basis points more. I think the Fed are absolutely right to sit on the sidelines a little bit, be patient, wait and see how that data evolves. And certainly when you look at other G10 peers, the Bank of England delivering a cut in February, the ECB, they're going to cut pretty rapidly. All other G10 peers are cutting pretty quickly. I think really that gives every reason possible to expect that the recent dollar upside will continue, barring, of course, a potential shock on the trade front and the idea that Trump's tariffs are perhaps not as bad as markets have been expecting.
Yeah, and those Waller comments were quite standout for me last week, because it twice he did it over the last couple of weeks. He came out, I think, NFP Day and said that he hasn't ruled out further rate cuts. And then he was even more explicit last week, saying that we could get 3 or 4 more rate cuts. And that March wasn't off. I think it was March, he said, wasn't off the table or something like that. We could cut in the first quarter. So I don't know if that was just maybe a little shot across the bows to warn the market that for whatever's happening with the data, the Fed still want to get rates down, and just maybe put a bit of water on the fire of the market getting perhaps too hawkish, because we've already had one bank saying that there's a risk the next rate move is up, Bank of America. So we had the flood of those calls changing 2 days into the new year as usual. But you can't ignore it. As I've said, that core inflation has been above 3% for 4 years. That's not, or nearly 4 years. That's not disinflationary. That's not getting back to target. And that's going to become a worry for the Fed, that naturally, in the same way we're talking about a lack of demand in the Eurozone causing inflation to come down, well, if you haven't got that lack of demand, you have decent demand in an economy, it brings with it inflationary pressures and it keeps inflation bubbling along. So again, it's just another conundrum for a central bank, but they're on the other side, like you say, to the rest of the world. Could we head towards a hike? I think it's going to take a lot more. I mean, I keep an eye, obviously, on US bonds and 10-year yields. And, you know, I have to say, a bit of a pat on the back to us. We kept the score on these yields, how they moving between the different phases of the Fed, pretty much, to the dime. And we had that first move up to 5% when the Fed were, coming to potentially the top of their hike. We said that might be a top because they're not going to do more. That's what it was. We had the dip back. We got down to that sort of 370 level. We said, well, that's going to be peak pessimism, if you like, for further cuts. And now we've seen this move back higher. I think if we get up to 5%, again, you'll get investors coming in, looking at that and saying, well, the Fed are still going to be wanting to cut. So that's a good level to park some money up, get some good yield. And that's why potentially we've seen a bit of a top in yields. Obviously, there's the Trump effect coming in. It was pretty key last week that we got those sets of data, CPI, NFP, and we couldn't build on that rally in yields, and the dollar couldn't build on the strength that it's seen, even though that data was pretty strong still. So that told me that maybe, at least for the Fed trade at the moment, we've traded the pause as far as it's going to go, and it's going to need something more before we move on again.
Yeah, I think that's a very good point. The other point I would make on that, just very briefly, is this idea of risks to the policy outlook. In 2024, we were sat here and, as you say, we were pretty much spot on going, the Fed are going to deliver rate cuts, or they're going to deliver those rate cuts more quickly and deeper. This year, yes, you've still got those two scenarios, moving gradually back to neutral depending on the data, moving more quickly back to neutral if the labour market were to weaken. But this year, you've also got a more hawkish risk, whereby you say, actually, if the labour market remains resilient and if there is a lack of further progress back towards 2%, well, policymakers are going to be happy to just sit on their hands and do nothing for a number of meetings, rather than just skipping one or two meetings at a time. So I think that hawkish risk has just taken away a little bit of a comfort blanket for equities. And although I think the market will continue to move higher, I think it'll be interesting to see how we adjust to that environment. But anyway, moving on, because, well, as you've rightly said, and often tends to be the case, we're a couple of weeks into January. Everyone's sort of shaking off those New Year blues and is back into the swing of things. And, well, 2025 starts now, I guess.
Yeah, we certainly need to get ready for what's to come. The first full trading week of the year can always be a bit funky. Money that came off the table towards the end of the year, late in the year, goes back on the table. Investors try and get positioned early for things to come, particularly Mr. Trump. And sometimes the first week can paint maybe a bit of a false picture or strengthens or weakens prior trends. Then we get the second week, and that's when we really start getting back into trading the macro themes, NFP, CPI, all the rest. That happened in part last week, as Michael explained. We got through some important data. But that week has really led up to now, and that's Mr. Trump taking office. And we've now had several glimpses of what it's going to be like trading Trump today and over the last couple of weeks. First of all, we had that Washington Post piece dropping sources story on tariff, saying they weren't going to be as bad as maybe we'd have been expecting. That moved markets one way. Then a few hours later, we got Mr. Trump popping up on his Truth Social platform, shooting that story down in flames. Markets moved all the way the other way. Then we had a few more stories that the Trump didn't push back on, so the market took those on board as that they were potentially, the truth coming. And now, lo and behold, over this weekend, he's launched his own cryptos, him and his wife, and they're rocketing. So we're getting into that space as well. So all in all traders need to be ready for how to trade Trump and his presidency. And the last 2 weeks up to today have been a perfect example of that. Now, if that sort of headline risk isn't good for your sort of trading, it may be bad news for some of the assets you trade, this might be a good time to think about adding some perhaps non-US related assets to your trading list, those that might not be so influenced by any sort of Trump knee-jerk movements and headlines. And especially if you're a part-time trader who isn't able to react to these things very, very quickly. Looking at FX cross pairs, for example, like Euro Sterling, Aussie Kiwi, NOK SEK, Norwegian Krona, Swedish Krona, they might be worth looking at. But otherwise, anything that's remotely tied to the US or US dollar is going to be a headline risk asset moving forward. So you need to be careful of that for your trading.
Yeah, you're absolutely right. I think that's an interesting potential dynamic as well. If we move from a market where the dollar is, effectively a sort of bedrock of stability and a haven, to one where actually the dollar becomes much more of a higher beta risk asset and moving more in line with things like equities. Obviously there is a correlation there, but if that correlation were to strengthen, I think that is an interesting dynamic. Perhaps that's the sort of scenario where, in more of a risk-off environment, rather than seeking shelter in the dollar, you'd see participants seek shelter in something like the Swiss franc or perhaps even the Japanese yen. But I think that is certainly a dynamic that's worth paying attention to. And just as a broader point, you're absolutely right. Markets, yes, to a degree, were headline driven over the last couple of years, but actually the focus was on much broader issues around particularly the monetary policy outlook. When will, firstly in 2023, when will hikes end? Then it was, when will rate cuts begin? Who will cut first? How quickly will those cuts progress, et cetera, et cetera, et cetera. The headlines that we saw were good for a handful of pip movement here and there, but it wasn't really prolonged. We didn't see much by way of sustained trends on the back of unexpected news flow. I'm thinking specifically, easy for me to say, in the geopolitical arena. The number of geopolitical headlines we had out last year, where the market move would be faded in something like crude or gold within about half an hour of the headline dropping. I don't think that's necessarily going to be the case as we move through into 2025. And of course, everyone adjusts to the Trump way of governing, effectively, which I'm going to get onto in a moment. So I don't want to steal my own thunder there.
Yeah, absolutely. And it is important, because we have to admit there are a lot of traders who don't trade full time. They're not like me. They're not at the desk. They don't have access to all the news wires and can react instantly to a headline. You could put on a trade and go to work, and by the time you get in, you've been blown out of the water and the market's already gone back your way. It's going to be very difficult, and it's up to us to learn the conditions that markets are going to move in and adjust to those conditions, so that we at least protect our accounts. Never mind trying to make money out of it. Just protect your accounts is always paramount, and making sure that you're not open too much to those sort of risks.
Yeah, absolutely. Adjust to those conditions and also respect those conditions as well, I think, is key. It's not a situation where, folks should be sat at their desks thinking, oh, I know better than the market. No, this is to coin a cliche, the new normal. This is how markets will trade for, well, at least the short term, but probably for the next 4 years. So buckle up, I guess, is the message from that. Anyway, let's move on to a couple of trade ideas and our plays of the day this week. Right, so I touched on this a second ago, but I want to look at how markets may react in the aftermath of Trump's inauguration, which obviously takes place, today. So it will have taken place by the time you watch this video. And I think really, of course, the focus this week will be on the fallout from these initial policy ideas, proposals, and executive orders that are put forwards. And naturally, despite the couple of months long transition period, there is still a hell of a lot of uncertainty associated with not just these initial plans, but also the plans for Trump's second term more broadly. And I think perhaps one thing that has gone a little bit under the radar is that I certainly expect a lot of these ideas to be front loaded, because, of course, the Republicans have control of both the House and the Senate until the midterms in 2026. So those real sort of cornerstone legislative ideas, you probably want to get those over the line sooner rather than later, before control of Congress potentially changes hands. But if you just think about some of the areas that Trump's going to be looking at, trade, when are the tariffs going to go into effect? Who's going to be targeted? How high are those tariffs going to be? And are they going to come all in one go, or are they going to be phased over a period of time? On the fiscal side of things, what does bond issuance look like? Treasury Secretary Scott Bessent taking over. How does he manage issuance movements across the curve, the idea of tax cuts as well. Obviously, the previous tax cuts from the first Trump administration likely to be rolled over. Are they extended? Are they deepened? Are they broadened? We don't know yet. And also immigration, a lot of rhetoric on that front. What impact does that have on the labour market? So I think when you combine the uncertainty on that front, coupled with the fact that we are now dealing with government by tweet or government by Truth Social post once again, it's an environment where actually being long volatility starts to make a lot more sense to me. And I think, you look at this chart here, you can see over the last couple of years, the VIX has been kind of bumbling along between 12.5 and 15 as a floor for most of that period. I would argue that the new normal is probably a floor around the 20 mark. So certainly expect things to get a little bit bumpier and a little bit choppier as we move through 2025. Now, Ryan, I think you want to look at WTI this week.
Yeah, but I have to say I found it very hard to pick a play of the day a few hours before Trump's inauguration, when markets could go anywhere over the next 24 to 48 hours. But I think there's one asset that might be a clear standout, and that's oil. Rumours obviously abound that Trump will declare an energy emergency so we can enact new powers very quickly. And from that, one of the big features will be to lower prices for fuels and energy, which is already going to impact oil. He's already promised to raise oil production in the state, so that will be a big part of it too. And we've got the fundamentals. We're still in a situation where manufacturing is very weak. Production is still quite high. So unless Trump's going to inspire a super boom in US manufacturing, the fundamentals still lean towards prices not going too much higher. So my play of the day is looking at oil shorts, as if it does go big, then that extra production in the US won't be supportive of prices. Also, technically, this is a trade I have been watching anyway, because we had a big level up into the 80.50 area, a big sort of start of an area between 80.50 and 82.50 as well. It's been a very strong support and resistance area. So I think shorts into that sort of levels, anything above 82.50, 83, then maybe something has changed and the trade will be wrong. But that's the sort of area I'll be looking at for shorts. And let's see if Mr. Trump delivers with his drill, baby.
Indeed. And the other thing to consider with that one, just at a broader level, if we do see crude take a leg lower and some tariffs on Canada, that could be a sort of perfect storm for the Canadian dollar to be grappling with as well. So that's perhaps one worth bearing in mind. Anyway, that does bring us to the end of another show. Of course, our first show of 2025. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to Kyriakos, our producer, for bringing this together as brilliantly as always. I hope you've enjoyed the show. If you have, do drop a like on the video, leave a comment as well. Let us know how you're trading the markets even, and your thoughts on everything that is going on and likely to happen over the next few days. And all three of us will be back with another episode of The Trade-Off this time next week. In the meantime, thanks very much for watching. Goodbye.